Hi, everybody. Making sure that we're recording. I just went to broadcast, let everybody jump in. It's going to take everybody a minute to get online. So let's just give everybody a second and then we'll get going. We had a total of 375 registers for today's webinar. So it tells me there's still a lot of need for education on this and interpretation and guidance. So we're happy to be able to give it to you. Actually, I'm going to pause recording for just a minute. All right, everybody. Thanks for joining us today. I was just telling everybody we're giving everybody a minute to get logged in and get settled. Everybody is on mute, and we're happy to bring this information to you. We had 375 people register as of my last check just a little while ago. And so it just still shows me there's still a lot of questions that people have. And we're just, we don't know everything yet. We don't know everything. The guidance just hasn't been provided, but we are happy to share what we do know. And also I have no problem telling you what we don't know. And so actually at the very end is the slide about, what do we not know yet? What are we still waiting on the answers for? So we'll get to that, but everybody's on mute. If you have questions, please put them in the Q&A panel. I've got Paul Alvarez. He's one of my staff here. He's CPA, and he is what I call my tax man, because any of you that know me know that I try to stay far, far away from taxes. I do all the cost report work side of the business here, and Paul handles tax and accounting. And so anyways, Paul's online. He's going to help me moderate, and so he's going to help filter through questions and keep that cleaned out. We've got 90 minutes scheduled. My material will not go that long, and so the plan is get through the material and then really have a lot of good quality time for direct one-on-one, questions and answers. I did receive a few emailed questions, and so I've worked those into the presentation, and I'll probably even then flip over to email, make sure I got them answered. I've got 2 in my head. So, all right, well, let's get rolling. So we're gonna, like I said, we're gonna do a deep dive into the PPP Loan Forgiveness. I did not introduce myself, I'm sorry. My name is Amy Knight with Knight CPA Group. If you've been around a long time, I'm formerly Amy Taylor with Amy Taylor and Company. We've been doing this for a long time. We are a CPA firm that only serves home health, hospice, nursing home, and assisted living. So if you're looking for somebody, or you have, you have an accountant that's not up on this, and I get a lot of the comment of, well, they don't really know home care or hospice or what have you. That's all we do, and it's what we do, and it's what we're passionate about. So we're a full service CPA firm, and we offer everything from bill pay through cost reporting and tax return. All right, there's my sales pitch. So let's go. So what are we going to go over today? We're going to go over what are eligible costs there's payroll costs, and then there's eligible non-payroll costs. We're going to talk about the covered period, and then a new development came out. They're calling it the alternative covered payroll period. We're going to talk about that. With forgiveness, you've got some key components that actually cause reduced forgiveness, and that's your FTE calculation. There are some exemptions and some safe harbor rules, as well as the wage reduction exemption and safe harbor rules. And then we'll briefly talk about the application process, and I'll give you an update. I did as much research as I can to find out what the Senate is doing today. And from what I can tell, they're not doing anything regarding the PPP loan, but I'll give you some updates on what we know about that. And I just want to reiterate, not that I see any there, but again, if you post a question in the chat panel, we won't probably get it answered. So please put them over into the Q&A panel. Okay, let's go. Quick housekeeping. There's a disclaimer. I'm not an attorney. You cannot sue me because I gave you bad advice on this. That's my CYA. And okay, so the original intent of this. I'm going to skim through these beginning slides, but I want to give you a little bit of background in case this is your first time joining any of our webinars. Again, the original intent was to provide a couple of months worth of payroll. It's 2.5 months of worth of payroll and give you a couple of months to spend it on eligible costs, and then it'd be forgiven, okay? But the intent really is to keep America working. The intent was for employers to take this money and pay their people, even if not working. We're in healthcare, and so you guys are in healthcare. I'm part of you, so I say you guys have stayed working. You're on the front line. But if you picture, a restaurant, think about the intent there. The intent there was for the restaurant to keep paying their people. However, when all of this came out, I really don't think anybody expected it to continue as long as it's going to. So there are forgivable expenses. Mostly it's going to be your payroll cost. As the law stands now, it says that for forgiveness, 75% of what you spend has to be on payroll. And then by default, that means that the non-payroll cost can only be up to 25% of the spent amount. We'll dig into this a little bit more, but that's the basics of the forgiveness. So payroll cost, that includes your salaries, health insurance, and retirement. The non-payroll cost, again, we're going to go a lot deeper into this. It's going to be interest on real or personal property loans. It's going to be rent or lease, real or personal property, and that's going to be utilities. What's not included in payroll cost, anybody's compensation, if they're outside of the US, probably not going to affect any of us unless you've got some executives whose principal residence is outside the US, that's disqualified. Any compensation in excess of $100,000 annualized is disqualified. Now, that doesn't mean their entire salary, just the part that's over 100,000. And then any qualified sick and family leave wages where you're getting a credit on your payroll tax return. So that's going to be things that fell under that Family First Coronavirus Response Act. And that's that emergency paid sick leave and emergency family medical leave act. So like when people are quarantined and you're still able to pay them, but you get a credit for it, you can't do both. You can't get a credit and claim it as a PPP loan expense. The earliest any of this loan forgiveness application could be accepted by the bank is going to be, really it's going to be day 57 because your covered period goes from day 1 to day 56. So it's going to be after your 57th day after the loan was dispersed. On the middle of May, it was a Friday, the SBA came out with their forgiveness application. It's 11 pages. Yes, that does include some instruction, but it's very, very complex. There is a big push by the banking industry to simplify that application process, the forgiveness application process. As of today, we haven't heard anything new on that. There were additional rules, we call them an IFR, interim final rule, that were posted on Friday, and it was late Friday, and that was Memorial Day weekend. Thank you very much. So, we spent part of Memorial Day weekend studying the new rules. But what was nice about these rules was they really gave us some clarification that we've been desperately waiting on. And so I've got all of that incorporated into these slides and into this presentation. As of today, the House passed a bill, HR 7010, and it's now in the Senate, and it's awaiting vote. And I've mentioned it again at the back end of it, but I want to mention it here because I'm going to kind of reference back to it a few times. We're waiting on the Senate to pick it up and vote on it. It appeared that there was mutual consent, so now it's just a matter of getting it done. In this bill, it was only about 8 pages long, and about 4 of those pages or 6 of those pages is really, what do you call that? Just, I don't know the word. It was just routine. It had to be there. There's another word for it. I can't think of it. The meat of it was only 2 or 3 pages long. It's going to change. It's supposed to change 8 weeks to 24 weeks. That's going to be a game changer for the restaurants. Hear me out. While you are thinking that 8 weeks to spend 10 weeks of payroll isn't possible, with some of the new rulings that came out in that IFR, with the way they've interpreted some guidelines and the clarity that came out, you really are getting about 10, if not even 11 weeks of payroll allowed. And we'll get to that. Maybe not 11, but probably about 10 weeks payroll. But again, it's going to extend it to 24 weeks. They're talking about changing the 75% must be spent on payroll down to 60%. Again, that really doesn't affect you all that much. Most of you are not having any problem spending 75% of the loan proceeds on payroll because you're so labor intensive. It also changes anywhere where it refers to 6/30/2020, changes it to 12/31/2020. And then it changes the loan from a minimum 2 years to a minimum 5 years. So that's about everything in that change that we're waiting on. Again, I haven't heard anything new. I was trying to see what they were working on today, and I couldn't find anything. So let's get into the meat. What's included in payroll cost? It's going to be your compensation. So salaries, wages, commissions, per visit pay, all of your gross wages. It's got to be taxable wages. It's not going to include our interpretation. It does not include mileage. Now there's another little case that you might convince your bank to include mileage. I don't think we're not going that route, but wages does not include mileage. Anything that's not taxable is not included. So if you've got a cell phone allowance, a device allowance, a car allowance, none of that's included if it's not taxed. If it's taxed, then it's included as wages. It also includes all your family, medical, sick leave, vacation time is included. If you've had to pay somebody like some severance pay because you let them go, that's included. It includes the employer's portion of employee benefits. So the company portion of healthcare costs, your health insurance, dental, vision, all of those, including the premiums and also including retirement contributions. So it includes those kind of benefits. And then it also includes SUTA, so your state unemployment tax. If you're in a state or a location that also taxes local, then it also includes any local taxes that the employer pays on the employee's compensation. There are special rules for the sole proprietor or partner regarding what is included for their payroll, and that would be net earnings from self-employment. We're going to cover that later. We'll get into that in a lot more detail. It also includes any payments to furloughed employees during the covered period. I'm not going to reread that for you. Basically, there's been a little bit of concern, especially with Medicare providers and Medicaid, saying, what's Medicare, Medicaid going to say if I'm paying employees even though they're not working? And for these purposes, it's allowed. I also don't think there's going to be any problem with the Medicare or Medicaid cost reports, at least in Texas. That's the only state cost report I can speak to. But as far as I'm concerned, my opinion is Medicare, they're not going to care at all. So if you're paying your people, what I would do on that, I would flag that as missed visits or missed hours and pay them their regular hourly or visit rate times however many hours that you're wanting to pay them for, if that's your situation. They also did clarify hazard pay and or bonuses are eligible for loan forgiveness. There was a little bit of question about that. Excuse me. So covered period for payroll cost, it's going to begin on day one. Day one is the day the money hits your bank account. So the day your loan is funded is when your clock starts ticking. And you got 56 days. 8 weeks is 56 days. Again, that may be extended. I'm going with what we know right now. It is not the loan date, and many people have kind of gone with that, but you're cutting yourself a couple days short. And you'll be in a little bit of hot water if you went with the loan date and included a paycheck that was maybe issued on that day before the money hits your bank account. You won't be able to include those. So just check your dates carefully. If the borrower has a biweekly or a weekly pay period, you can elect this alternative payroll covered period, okay? On the alternative payroll covered period, it starts not on the day that your money hits your bank account, so not the date that you're funded, but the date that is the first day of your next payroll period. So day one of your next payroll period is day one of your alternative payroll covered period, okay? Then you're going to count 56 days from there. The alternative payroll period only applies to payroll cost, does not apply to non-payroll costs. So for non-payroll costs, it's still going to be the true 56 days starting from the date you were funded. So that can get a little questionable there. I'll be honest, I've run numbers both ways. I don't see a drastic benefit of electing the alternative payroll cover period, but I do think it varies case by case, so you really want to look at it for your very specific situation. This right here was probably the best interpretation that came out of the interim final rulings that was very favorable to everybody involved. And basically they came out and said, we're going to count anything that's paid or anything that's incurred. We're counting them both. And you have to be very, very careful how you say this. It doesn't mean we're counting things that are paid and incurred, because that can get real technical to us CPA types, because to be paid and incurred is going to be a very limited view, meaning it's got to be paid and the payment for that, it had to be incurred during that period. No, it's either got to be paid during the period or incurred during the period. So let's get into that. So you've got 56 days. You get to count any check date that falls in that 56 days, regardless if you're under the regular covered period, starting with day one being your funding date, or if you've elected the alternative payroll covered period, okay? But you also get to include the days that are in your covered period at the end of it that you've incurred, but you have not yet paid, okay? So if you've listened to us, we had said, look, we're recommending you cram another payroll in there right at the end. That's not going to be necessary, because now and I'm glad, because God forbid, we do not want to confuse employees with their paychecks. It creates a lot of questions for you guys. That's more burden than it's worth. So you're going to get to keep your payroll consistent, and you're going to get to include, let's say you had 6 days at the end of the pay period, or at the end of your covered period that hadn't been paid yet. As long as you pay them on your next scheduled check date, then you get to include them as part of your covered eligible payroll costs. Now, digging into that a little deeper, well, this gets technical, that slide does. So back up a little bit. So if you had a pay date that fell 2 days after you got funded, and you're starting with your funding date, right? But it includes 0 days in your covered period. Like the pay period for that check date had nothing to do with your covered period. You get to count it, okay? Then at the end, you're getting to pick up any days that are in your period and not covered. You are most likely going to end up with probably close to a full 10-week period, maybe even more. I've run the scenario on our semi-monthly payrolls that are on a 2-week lag. This is where it's going to pay off to follow that best practice that says, best practice in business says you have a 2-week lag in payroll, not 1 week, not 10 days, but 2 full weeks is best practice. It gives you the most time to calculate your payroll, make sure you're have time to gather all your hours and get everything compiled right. It gives you plenty of time to get it to the payroll provider, yada, yada, yada. If you do that, you're going to definitely get 10 weeks, if not even more. So if you were given 10 weeks of payroll to spend, even without them extending the 8 weeks to 24, you're probably going to be able to meet your spending requirement within the covered period and just move on to the forgiveness phase of this whole process. So, and something I want to mention that's not in the slides anywhere, if they do extend it to 24 weeks, that does not extend any of the limits. It doesn't mean you get to pay people more than $100,000. It does. I don't even think you'll get to extend the annualized $100,000 annualized. I don't think that's even going to happen. It doesn't extend how much you get, or it just gives you more time to spend. And if ever you're not understanding, pretend you're a restaurant. That's the best example I can get. Pretend you're a restaurant and you can't even open your doors back up by June 30th. Pretend you're a restaurant in New York City, right? They're probably not even going to be open yet. But even if they are, like here in Austin, they opened up last weekend, but only at 25%. And then this week is 50% or something along those lines. Don't quote me. You know, are they going to be full? This gives them more time to spend that 10 weeks of payroll. They got more time to spend it. So they're going to have to ramp back into business. You guys mostly aren't. And I know some private duty providers, especially like PAS service providers, you guys probably took a bigger hit than a lot of the Medicare providers because your parents were probably at home and able to care for their children themselves and didn't need services. And that I've seen the biggest drop there. You're going to have more time to spend it if that new bill is passed. So again, it hasn't passed yet. So let's get back to what we know today. So you get to count that payroll that hit in the very beginning, and then you get to accrue the days at the very end. That's what I'm trying to communicate. Payroll costs are considered paid on the date that the checks are either distributed to the employees, which is likely going to be the check date, or the day that you initiate the ACH. So again, the check date, the date it hits their bank. We're using check date across the board. That's check date and paid date are the same thing. Date incurred means the date the employee worked. If they did not work, but you're still paying them, it would be the day they would have normally performed their work, okay? So I kind of already went into this, and I'm sorry, I have a bad habit of talking out of turn with my slides. I do not do well at just reading slides, so hopefully that's a good thing. Your alternative payroll cover period and how the paid or incurred works is what I was just going over. Now, here's a little extra credit or a little extra that you get if you do elect the alternative payroll covered period. And I don't really understand why they elected this because again, remember this only applies to biweekly or weekly payrolls, but you can elect this. And what they've said is because you're, because you're biweekly or weekly, you've elected this alternative period. We're not even going to make you calculate the portion of that payroll period at the end. We're not going to make you prorate that payroll. We're going to let you just include the whole entire payroll. So let's say you get to the end of your period, you got 6 days that fell in your covered period, and you've got 4 days that were outside of your covered period. You pay it on its next scheduled pay date, you get to include the whole thing, the whole 10 days. Why they did that for biweekly and not semi-monthly, I don't know. Can't answer that question. I feel like there were some non-accountants in the room making those calls. I don't know. So there's another little extra oomph that you get out of it if you elect that alternative covered period. But you've got it. You need to assess both sides and see which one works better for you. So how do you calculate owner's pay? This has been a big, big question. There are different kind of owners, and the ownership, how it's treated in general, it's all the same, but there are some technicalities based on if you are the owner of a C corporation or an S corporation. That makes you an owner employee, which means you should be on payroll and receiving a W-2. Or if you're a partner or a member of an LLC, So that would be a member of an LLC. If you're an LLC, it depends on how you're taxed. Are you taxed as a C Corp, S Corp, or partnership? If you're taxed as a partnership, then you're going to be treated as a partner and you're going to be called self-employed. And then if you're truly a sole proprietor and you don't even file a partnership or a corporate tax return, but rather it goes to your Schedule C return, Schedule C on your personal return, then there's different rules for each of those that we'll get into in the next slide. But the generality of it is the amount of loan forgiveness is going to be limited to the lesser of your pro rata 2019 compensation or 15,385. Now, let me dig to a couple of points. So it says the lesser of 8/52. So what they're going to do is they're going to take your, here's the easy math. In 2019, if you only paid yourself $52,000, that's $1,000 a week. They're only going to allow you $8,000 of forgiveness. And when you do that calculation, it includes your gross wages as well as all of your benefits, your health insurance and your retirement. Your limit of 15,385 includes all of that. As we understand it, when you're looking at maybe your managers or your field workers that are out there killing it and making more than 100,000, for them, the cap of 15,385 only applies to the wages, the gross wages, and the retirement and benefits is on top of that. Paul, correct me if I'm wrong on that. I think for employees, we still get to count retirement and health benefits in addition to the 15,385.
That's right. That's right.
Okay, cool.
But not for owners.
Right. So this is the clarification that came out at the owners. Now here's a catch that's new. This is across all businesses. So if you're an owner and you have 4 different agencies, you don't get to pay yourself 15,385 out of all 4 agencies. So that's going to be capped across all agencies. If you're an owner and you just didn't pay yourself well last year, you're going to be limited to what you paid yourself last year. That's really going to affect the C Corps and the S Corps, because if you're an S Corp owner and you just pay yourself a minimum salary and you take the rest through distributions, you're going to get not penalized, but you're going to be limited because of that. Again, that's another best practice. You need to be paying yourself a reasonable compensation, which is your real compensation, and then profits are taken out through distribution, not compensation. Okay, the one question, the little comment here at the bottom, there's a question about, it's called family attribution, that's still unanswered. And what that means is, okay, can I put my wife on payroll and my kids on payroll? And our opinion is yes, there's nothing excluding that, although they may come out and issue some further guidance on it. So self-employed limits. So what I was just talking about, it depends on what kind of forms you file. So Schedule C filers, you're limited at your 2019 profits. And then general partners are limited at their 2019 net earnings from self-employment, but then you got to reduce it by your Section 179 expense, your unreimbursed partnership expenses, and then if you got oil and gas properties. And you got to multiply it by 0.9235, and that has to do with self-employment tax and payroll tax. So there are some little, really specific details that that might apply to you. So just make sure you're getting guidance on this. Okay, moving on. I'm trying to catch up where I'm getting kind of behind. Non-eligible payroll cost. Eligible non-payroll cost. It all starts getting foggy after a while. They must be business related, and they must have been in existence on 2/15/2020. So you cannot go acquire something new and then deduct the expense. So it's going to be interest on mortgage, which is going to be real and personal property. It's going to be rent on real or personal property, which is going to include like office rent, storage rent, equipment leases, auto leases. I will say on auto leases, or really any kind of lease, it really is probably going to have to be in the business's name. So if you've got an auto lease and you're deducting that through the business, but the lease is in your name, the bank probably is not going to allow that. Because again, the bank is going to make the initial determination. If they decline you for forgiveness, you can appeal it to SBA. We'll get to that later. But the bank's going to make the initial determination. I don't think the bank's going to allow it if it's not in the business's name. And the bankers may. We'll see what happens. Utility bills. That's going to be electric, gas, water. It says transportation, telephone, or internet service. When transportation is there, Paul did a bunch of research on that. Don't even unmute yourself because he'll start talking technical. And we do not interpret it to mean mileage reimbursement. But there was new language out that talks about truck fuel and this and that for sole proprietors. If you need to, I would say see if the bank will allow mileage reimbursement. Again, it's going to be a non-payroll cost, so it's going to be limited out to 25% of all of this. Can't add up to more than 25%. This is one of, but it might, they may let it, they may not. I don't know. If it's not, this is me being snarky, if it is not listed above, the answer is no. That means your billing subscription, your billing dues, your billing software subscription is not a utility. That one I've answered 50 times. Please don't put it in chat. The answer is no. They are going to be very specific. And the reason why I say this and the reason why we've listed it out is this is exactly how it's listed in the act itself. So when the act is that detailed, I do not expect banks to give any fudge. They may fudge transportation because everybody's like, what does that mean? Apparently in the Northeast, there's kind of like a transportation tax. It's like a utility bill that everybody pays to pay for transportation. And so that's what they mean up there. But we'll see what happens. Again, these cannot be more than 25% of the total debt, forgivable debt. Again, that might be adjusted to 40% if this new bill passes. So on this non-payroll cost, again, they've got to be paid or incurred. And this, I just want to say, don't try to be shady. I think that most of you will have enough payroll cost to not even have to deal with this stuff, but you cannot prepay your rent for 6 months. You can't prepay anything really. What it says, if it's paid during the covered period, it's included. And if it's incurred during the covered period, it's included. What we don't know is if you were 3 months behind on your rent and you pay all 3 months plus the 2 months that are covered, it's going to be up to the bank. But the way their intent is, let's say your covered period is May and June, and we're doing easy math here. So you paid May rent, let's say you paid May rent. That's not even a good example. It's really best with utilities. Let's say it's May and June is your covered period. You pay your May, in May, you paid your April utility bill. And for easy purposes, it covered the whole month of April, but it's due on May 10th and you paid it May 10th. It counts. And then on June 10th, you pay the May bill. And then on July 10th, outside of your period, you pay the June bill, which is for your period. That's what they're saying. It could be incurred or paid. So because you paid April in the period, it's covered, but June is still covered because it's part of your period, even though it's paid later, and it's got to be paid on the due date following the close of the period. I'm sorry, that's the example I just went through, okay? Oh, and go back, let me go back one sec. I will say they will make you prorate that bill. No utility bills are clean. So, or your coverage period's not gonna be even month either. You do have to prorate it for only, if there's 30 days in the billing cycle and 10 days are in your covered period, then you've got to prorated, 33% of it will be included, okay? So again, basically you are not going to be able to deduct these, whatever expenses are forgiven cannot be deducted for taxes, which is a backdoor way of saying forgiveness is taxable. I'm not going to go through the details. There was some, bad, there was some criticizing going on about it, but that was April 30th. A whole month has gone by and nothing has happened. So I'm losing faith that that's going to get fixed. We'll see what happens. To be continued on that. The good thing is, if I'm advising you, I'm telling you to be very conservative and expect that it's not going to be deductible, therefore it's going to be taxable. Plan on that tax liability. The good thing is it won't be due until next spring. And so they've got a lot of time to fix that. And then even if they fix it, months down the road, you will get the benefit of it. So that's a good thing. So forgiveness, looking at forgiveness as just an overview, one thing I want to point out is only up to the full amount of the loan plus the accrued interest can be forgiven. You cannot spend more and have it forgiven. Only up to the loan amount can be forgiven. They did issue the application, as I mentioned. I haven't done a lot with it other than understand it, because I expect the banks to come out with their own version of it that they're going to require that you use. So I advise you to get familiar with it and create your own worksheets to start tracking your stuff. You really want to be tracking this as it goes, not all at the end. And but don't spend too much time creating some masterpiece, because the banks may not accept it. They may want you to put it in their own forms. Again, you can start filing for forgiveness after day 56, but no later than 60 days after the end of the cover period. Again, that's a rule that might change. We'll get to that. And then, but with what we've got, basically you've got 60 days from the end of your period to ask for forgiveness, to file your application. Then the lender has 90 days to make a determination. If they deny it, you can appeal directly with the SBA. So there are some reductions that can happen to your forgiveness, and let's get into those. And this, I think, is what scares everybody. There could be a reduction based on full-time equivalents if you have reduced FTEs versus when this all started. And you don't restore them, you could experience a reduction in your forgiveness. Same thing with employee salaries and wages. If they're reduced and you don't restore them, you might lose some forgiveness. And then a reduction due to not spending at least 75% of it on payroll. Now, one of the questions that comes up often is, can we spend more than 75%? Absolutely. You could do 100% on payroll and not even worry about utilities, especially if they extend it to 24 weeks. If you think, look, I just don't even want to try to include utilities or all that, you can spend 100% on payroll. There's nothing that prevents you from that. And then lastly, if you did get an EIDL grant, that will reduce the forgiveness, and that's okay because it's still free money. And we'll get into that a little bit too. So wage and salary reduction, I said it backwards, salary and wage reduction. This means that if you cut people's wages more than 25%, you were going to experience a dollar-for-dollar reduction in your forgiveness. Now, it does exclude anybody that's over the $100,000 limit. I'll get to that in a second. And there are some exceptions, so bear with me. So reduction in employee salary, which means their total annual salary, or a reduction in their wage, which fortunately, the powers that be saw that this was a problem. It means their hourly or per visit rate, not their total pay. And I'll get into that, okay? And it's during the covered period or the other period, okay? So it ignores anybody that's over the $100,000 threshold. it ignores them until once, if you cut them, anything you cut in excess of 100,000 doesn't matter. Now, once they're at 100,000 and you start cutting them, that percent matters. So if somebody made $150,000, you could cut them from 150 to 100, no penalty. You could still cut them from 100 to 75,000, no penalty. Now, once they get below 75,000, now you start getting a penalty because that's more than 25% under the $100,000 threshold. And then everybody else is, if you cut their wage, their rate, either their salary rate or their hourly per visit rate, more than 25%, then it starts being a problem. It is a dollar for dollar reduction. So if you cut somebody from, easy math, if you cut somebody, $1,000 more than 25%, then $1,000 is going to come off of your forgiveness, okay? Now, the comparison period that you have to compare, okay, their pay now versus when, is first quarter, okay? That's what you're looking for. And I'm sorry, I'm very thirsty. So this is what I was just saying. They did come out with a clarification on the wage reduction. And they meant that they very clearly said, look, if you're in a situation where you've had reduced hours and therefore your staff's total pay is reduced because hours are reduced, you're already going to be penalized. And I don't like using that word, but you're already going to be penalized with regards to forgiveness because of your FTE count, because it's based on hours worked. So we know you're going to take a penalty there. So we're not also going to penalize you on the wage reduction. So as long as you didn't reduce their pay rate, the amount per unit that you're paying them, then you're not going to get penalized twice, okay? That's what this means. This is, it's the government. Okay. What they're saying is, this is very technical, I'm going to breeze by it because this may be a moot point anyways. For the safe harbor, it says basically if you restore the pay cuts that you made by 6/30, then you're not held, you're not in trouble for that. But what it says is, it says that only counts, it counts if you reduce, if the pay cut was from 215 to 426, if during that period you reduced them as compared to 215, as long as you restore it by 6/30, you're in the clear. Clear as mud, right? I think a lot of this is going to go away, so I'm not going to labor the issue. And honestly, in our field, I haven't seen a lot of people have to actually pay wages too much. Because the question is, well, what if you cut them after 426? And it's not clear. Not only is it not clear, it's in the law, it's not worded right. So it would say that there is no safe harbor for that. So I don't know, click the wrong button. Did I skip a slide? Hold on, let me go back. Nope, okay. I keep pushing that. I'm sorry, I'm using the new tracker ball for reasons. Anyways, FTE reduction. The second way that you lose forgiveness under section 1106 of the statute is basically a headcount, a reduction in headcount. Again, the reason I went over the original intent of this whole program is to keep people employed, because that's what they're after here. They want people working, not taking unemployment, but they shouldn't have at the same time extended unemployment and made it so lucrative, right? And so now they've come in and they said, no, we get it. Unemployment's super lucrative now, so we've got, let's fix these rules a little bit. No, here's the original rule. Basically, you're going to have to calculate your FTE on two periods, and these are called the reference period. So you're going to look at your FTE count as an average over 215 last year. So last year, 215 to 630. Then look at it this year from January 1 to February 29th, okay? So those are your two reference periods. You want to calculate both of those. Whichever one is lower, that's the one you want to use, because you want the lower number to compare to after COVID, okay? And you can elect which one you get to use, but calculate them both and see which comes out to your favor. How do you calculate the FTE? Well, basically there was a question, is it like Obamacare? We use 30 hours. No, you're going to use 40 hours a week. So what you want to figure out is in your pay period or in the period in which you're measuring, how many work days, how many business days are there times 8 hours a day. That's going to be your denominator, but that's basically going to be 40 hours. Hold on, I'm getting confusing. If you're looking at it just for a week at a time, how many payroll hours were there that week divided by 40? But if you're looking at multiple weeks, then you're looking at 10 weeks divided by 40 hours per week, so 400 hours. That's how you get your FTE. So you're going to do a lot of FTE calculations. The easiest thing to do is take your payroll journal and you calculate, all right, total payroll hours paid, how many hours were in the pay period, probably 80, maybe 88, maybe 96 if you're semi-monthly, depending on how the dates fall. But let's say it's 80, so it's total payroll hours paid divided by 80 hours. That is your FTE count. If you've got salaried staff, you need to be entering hours for them. Even if you don't on the normal, then maybe you do for now, you just standard populate 80 hours. Or maybe you know that they don't have any hours in the payroll system, and so you manually add them as a full FTE. So you come up with, you know, you got 76.82 FTEs, and I've got 4 salaried people, so I got 80.82 FTEs, right? So just don't overcomplicate it. Now, there's this alternative method that I don't think is good for anybody in our listening area. But they said basically for anybody that works 40 hours or more, just use a 1. And for anybody that works less than 40 hours, put them at 0.5 and then calculate it that way. That's going to be very complicated. Think about the provider services out there and you've got 1,300 employees. Do you want to go figure this one by one? I don't think so. You're going to take the total payroll hours paid divided by 40 hours a week and call it good. Now, you're going to have lots of FTE to calculate, and they're listed out here. So you've got 2 different baseline. These are your reference periods. Again, last year, 215 to 630. This year, 1/1 to 229. You're going to calculate those. You're going to calculate it on every single payroll that happens during your covered period. You're going to calculate it for the payroll that covered 215. That's going to affect your safe harbor. You're going to calculate it from 215 to 426. That's in the safe harbor calculation. And then you're going to calculate it again at 630, which again affects that safe harbor calculation. So you're going to need all these calculations. So you're going to get, really good at calculating FTEs. There are some exemptions. These came out a couple of weeks ago, a few weeks ago. So exemption number 1, you can exclude any reduction in your FTE count if you basically, somebody left and they won't come back because they're taking unemployment. Like, we can read all that, but that's the bottom line. But there are some things. It does have to be a written offer. If you so if you had employee leave and go take unemployment, or even if you laid them off and you're like, I don't have enough work for you. I'm thinking of provider services. We don't have enough hours for you. You got 0 hours this week until further notice. Your client doesn't want to be seen. Then the employee goes and files unemployment. Now they're on unemployment and they won't come back because they're making more money on unemployment. You've got to make a good faith offer. It's got to be written. You've got to offer to rehire them for the same number of hours, the same rate, and they rejected it. Try to get their rejection in writing, but document all of this so that you can fit under this exemption. And you also then have to notify the state unemployment office that they rejected your offer, and you got 30 days to do that. I know in Texas, there's an email address. I'm sorry, I don't have it, and you're going to have to find it on your own. I'm sorry. But there is a place you can email to let them know who's working and, not who's taking unemployment and you've offered them to come back and work. So that those head counts, they don't count against you, okay? Exemption number 2, This one is also good, and I'm actually a little bit surprised, but it's good. If you also get to exclude anybody that was fired for cause, voluntarily resigns, or they asked for a reduced schedule and you gave it to them. So you just get to take them out of your count. That's the easiest thing, is to take them out of your count altogether. Okay. Now, here's the safe harbor. Again, this is just as squirrely as the safe harbor on the wages. But basically what it says right now is if your FTE count was reduced between 215 and 426, as compared to 215, and you restore it to its full level by 630, there's no reduction to your forgiveness. And I know what happened here. Basically, they're saying before 215, everything was normal, and they expect everything back to normal by 630. And 215 to 426, because 427 is when this act was enacted and signed into law. So they're basically saying, okay, if prior to this date, you reduced FTEs, you've got until 630, because by then we think everything should be back to normal, to get everything restored back to normal. But that's, and especially in our part of the country, I talked to a provider yesterday. She's like, I really didn't see a reduction in March or April, but we started seeing a reduction in May. And so that becomes the question, well, what if your reduction was after 426? I'm telling people, okay, cool. Well, still reestablish it by 630 or the end of your 56-day period. The end of your covered period is what we're shooting for, just to be safe. And there is nothing that says how long you've got to keep them back on the work roster, if you will. So one question that came in from, before I get off of this, from an emailed question that it applies to everybody is, all right, with regards to provider services, so-and-so, I had Susie Q working, and now her patient doesn't want to be seen anymore for various reasons. So Susie Q doesn't have any work, and I've got nobody else that she matches up with. How am I going to restore that FTE? They're not looking at an employee-by-employee basis on this. It is total hours paid. So if Susie Q is still taking unemployment, that's okay, because you've brought John Doe in, and that patient is still not wanting to be seen, but you've got other patients and Susie Q can't fit them, but John Doe can. That brings your FTE count up, which then leads me to your next problem. What do you do if your FTE count is down because your census is down? Very, very relevant for the providers out there, for the PAS providers. There is no answer. There are some creative ways to work on it. There's no talk of any guidance coming out on that. Somebody just asked me to go back a slide for a second. Let me just flip back, which, by the way, slides will be, I've already got them hosted and in a link on the auto email that'll go out. And then I will also put a link to the recording as well, just so you know. But I'm happy to go back. So creatively thinking, if you're a large provider, it's going to be more difficult. One of my thought processes is it may be worth paying some extra hours on that last payroll and calling it missed visits, right? It's eligible for PPP forgiveness because it's going to be wages, but I would make it missed visits, and I would call it missed visits. And I would put, let's say you've got an attendant that normally does 30 visits a week, and they're only getting 10 visits a week. I would pay them an extra 20 visits per week. So say it's a 2-week period, 40 visits. That brings them back up to their normal FTE, payroll hours, which equates to FTE count, even though they're not seeing patients, because that's going to restore your FTE count. I would do that on that last payroll in your covered period, or 630, whichever comes first. That's one way. I still think there may not be a way around that. I don't know what it is, because they're really going to require you to restore that FTE count, even if your business isn't restored. I'm trying to recall the second part of that question, because if I mess up my screens, it'll take me a minute to get them back. I'll have to come back to it. It'll come back to me. So that might be a problem for some people, you know, trying to get back fully restored. Again, that's when the 24-week extension comes in, and then everything that goes from 6/30 then goes to 12/31. But are you going to leave your forgiveness hanging out there until 12/31? You know, I don't know. Oh, that's what that was the other point of the question. The other point of the question is, I've heard a lot of people complain, and don't shoot the messenger being me, that, well, there's no way I can calculate that person's average hours. Yes, you can. It says it's going to be over the period of 1/1 to 2/29. It's going to be your total company average hours between 1/1 and 2/29, regardless of how many hours that employee worked. And regardless of clients coming and going, whatever that number is, divided by the number of weeks in that, you know, number of hours in that time frame, that's your average FTE, okay? All right, moving forward, that's what we just talked about. So real quick, EIDL Grant. EIDL was that economic injury disaster loan, and you could go say, yeah, I want an advance on that. It was $1,000 up to $10,000. A lot of people got that. If you did, that amount that you got in that grant will reduce your forgiveness dollar for dollar. The purpose is easy numbers. You got a $100,000 PPP loan and you got a $10,000 grant. So you got $110,000 total. Well, the $10,000 reduces your PPP forgiveness. Say you got 100% forgiveness, so $100,000 reduced by your EIDL grant. So now you only get $90,000 forgiven, but you still got $10,000 for free. So in the long run, you got $100,000 free and $10,000 has to be paid back. That's how that's going to work. Required documentation. This is going to be basic stuff. I want to kind of get through this so we can get to questions. Bank statements, canceled checks is going to an extreme, but maybe for the non-payroll cost, you are going to be required to produce all your payroll tax forms, your quarterly payroll tax reports. Your payroll journals are going to suffice for any payroll kind of forms that you need. They're probably going to ask for your bank statements. You're going to have to provide documentation of these FTE calculations. So start getting that figured out, put it in a spreadsheet, accumulate all the reports that you use to calculate any of this, start putting it in a file because it's going to be required. For loans for like interest, amortization schedule is going to be good. Probably canceled checks or maybe your bank statement showing it was paid would be good if you don't have like little payment coupons or something. For rent, you're going to want a copy of your current lease and the canceled checks or the bank statement showing it was drafted. You're going to have to include, so for any of the like utilities, because it had to be in existence prior to 2/15, you're going to have to show your February invoices or canceled checks to prove that it was already in existence. Let's see. Oh, rehires, resignations, terminations, all of that needs to be kept, and all of this has to be kept for 6 years. I do expect you're going to have to provide a lot of it to the bank. So what do we not know? There's still a chunk we don't know. How long, if you restore that count by 6/30, how long do you have to keep them on the payroll to maintain them to get the forgiveness? I don't know. Family attribution rules for payroll, right now there's nothing specified. Does it apply to owner spouses? That's not been addressed anywhere. And then also related party rules when it comes to things such as real estate. So like if you're paying self-rental is what we call it, that like if you own the building and you're paying rent, the agency pays rent to you. As far as right now, that's allowed. Nothing says it's not allowed. what if you don't get forgiveness? It is very possible that it may happen that way. It's still very favorable money to take. It will be a loan. At current moment, it's going to be a 2-year loan, starting the date of the loan. So the date you sign the loan, the loan date, it's on your loan documents. So right now you have a loan already. You don't have free money. You don't have a forgivable loan. You have a loan that can be forgiven, and it's at 1% interest. New legislation is to change that to a minimum of 5 years. Now, you won't start being, well, I'm not even going to get in. As of right now, payments won't start until October, November. There's a 6-month deferral. And so if at the end of it, I had a provider that was very large, and they had a real dilemma on the 8-week thing because they would have had to pay out a lot of money in bonuses, way more than what they could justify to their staff. And with it being taxable, they were going to have to pay tax on all of it. You can pay it back at any time. And so for her, it wasn't worth taking that additional money and being taxed on it just to have it forgiven. She would rather just give it back. So you can just give it back or use the money and use it as and keep it on a loan. Now, if you use it as a loan, the law reads, I don't know who's going to monitor it, but law reads that the use has to be still for one of these qualified expenses. So there's still some strings attached to it. So it gets a little questionable. So here are the possible changes, again, in a little bit more detail. They might, the HR 7010 changes it from a minimum of 2 years to a minimum of 5 years. It changes the covered period and extends it from 8 weeks, extends it out to 24 weeks. It extends the period to increase pay or reinstate employees from 6/30 all the way out to December 31st. It allows borrowers to defer the employer's portion of Social Security payroll taxes. Right now, that's allowed as a benefit, but not if you've got a PPP loan, okay? So it would allow you to defer that 6.2% payroll tax like everybody else can. And it gives you the unable to rehire an employee on payroll at. So again, it's about rehiring people. It moves it all the way out to December 31st. Sorry, I stuttered on that. Here's where it changes the deferment from 6-month deferment, and it replaces it with a deferral until the date on which the amount of forgiveness is determined, when the amount forgiven is actually remitted to the lender. Okay, so basically saying you're not going to have to, if you go ahead and apply for forgiveness within a timely manner, you're not going to have to start making a payment while the lender takes his time to make his determination, which I don't think is going to happen, but regardless, I think the lenders are going to be in a hurry to give forgiveness because they want their money back. This was their money they gave you. So they'll get paid back by the SBA. So this is saying instead of 6 months and you have to start paying it back, even if forgiveness hasn't been determined yet, it's going to fix that. And then if you don't apply for forgiveness within 10 months of the last day of the cover period, then it automatically just starts being due and it's a loan and you miss your opportunity to file for forgiveness. I don't think anybody's going to do that. So what should you be doing now? Keeping records, very, very detailed records. So, you know, look at that application, get familiar with it, make sure you understand how it works. And I would just start doing those calculations as you go. Look at your covered period versus the alternative payroll covered period so that you know what your 56-day period is. And then, of course, ask for help, seek help if you need it. We've got a lot of agencies that we're working with on this. I've had to really call in reinforcements and extra troops to help with it. We're helping so many people, and I'm happy to be helping people because we're just here to help. This has been, it's a lot of work. It feels like a never-ending tax or cost report season. I am getting carpal tunnel and problems in my arm from using a mouse all day long. My eyes are straining, but it's been the most rewarding part of my career because people are so appreciative of this help. And so we're just here to help. We continue to put out emails as much as we can. I'm putting a little bit more out on social media than I am actual email content. So look for us, go find us on Facebook. I announce everything there. I'm getting to where I like to do little video blogs. So then, again, there's my disclaimer. So let's go to questions. Paul's gonna help me, and he's kind of organized them to make sure. One question, let me get this one real quick, that was asked via email. It was talking about, are we going to interest? The one answer that I didn't answer in the webinar itself is interest deductible on like capital loans. I don't think so because it says real or personal property. So we think the answer is no. Some banks may allow it. I don't think so. I wouldn't count on it. So that was the one question that came today that I was not able to get a for sure answer on, and I didn't get it fitted into the webinar. Okay, what do you got, Paul?
It says if the time limit is extended to 24 weeks, do you have to keep the same employee count for 24 weeks?
Well, that's the big question. And so, you know, I didn't tell you guys that I've got a panel of CPAs that I sit with, and we're all working on this together. And there's a couple of guys in the group that have big hotel chains and lots of restaurants. And so they're very in tune with wanting to know what's going on. And that is the big question. If they extend it to 24 weeks, I don't think so. Again, this is an assumption, but it's kind of how we've had to do everything for the last couple of months. My thought process and what we're advising our clients is, and literally we have a loan that matures, or it's 50, the covered period ends a week from today. And I think we've got one that ends this week. I don't know. Anyways, so we're on this. We're advising, if your 8-week period is coming up very soon, if you can spend your money based on that paid or incurred and how they're allowing you to count both, where you're kind of getting almost 10 weeks or 10 or 11 weeks of payroll, my thought process is I would go ahead and apply based on the rules that we know them now. If you're in good shape, I would just apply and get it applied for and get it forgiveness in the works before the rule, because if you're good now, do it now so that any rule changes maybe don't possibly hurt you, meaning, okay, now you got to keep that count for 24 more weeks. I don't see that as being the case, but I don't know. Now, if it would benefit you that I need more time to be able to get my FTE count back up, then by all means play that side of the field. Because that's basically what the way I read it is, you're going to have spent through your money, even if you've had a really reduced business, you're going to spend through your money in 12, 14, 16 weeks. And the way it reads is you've got until 24 weeks to reestablish that FTE. So maybe you spend it, but you still got time to get your FTE count back up. I'm not sure. The reason I'm so hesitant, I don't want to have to wait that long. And I wouldn't want it just hanging out there. I would want to do what I could do to maybe just spend money. And again, if you're super large, maybe it's not feasible, but can you spend that money to pay everybody missed visits for that one payroll on 6/30 and apply for it now and be done and move on down the road? Say, hey, I met the rules as they were the day I was applying for a forgiveness, so I want to follow those rules. That's kind of the approach that I'm taking. What else you got?
There's another one related to paid or incurred. It says if you pay your first quarter SUTA taxes on April 30th, do you get to include that?
So there is no clarification about when your SUTA taxes are paid. Yes, I would say that yes, if you paid first quarter on 4/30, you would include that. However, that means that you're not going to get to, well, yeah, it does. So that's a good point. So then if you don't pay the next quarter until 7/31, you should be able to accrue that expense, right? Because if you incurred it in May, you know, so if you paid it in April, then that means your period covers April and May, maybe part of June. Then you need to accrue that portion of your SUTA tax also. Okay. What else?
This one here says, I had 3 employees take time off to have babies during this time.
My question would be, was it paid? Anything you paid, you know, counts. I would think that would fall under one of those exemptions of voluntary termination, even if they're going to come back. That's how I would work that. Again, I want to reiterate or even say for the first time, the banks want this forgiven. They are on your side. These are not ZPIC. These are not UPIC auditors coming in trying to shut you down. So that's the good thing. Now, I will say we did deal with some nasty bankers that just really didn't want to be involved in this, but they kind of had to be. And so they're kind of cranky and crotchety. But for the most part, the bankers have been very helpful and very on your side. So I would think in that situation, I would just explain it. And I would call that a voluntary termination until they come back. So my thought. What else?
Okay, there's a couple of questions on, I guess, CARES Act, relief fund, and stimulus payments, et cetera. So yeah, we know this is not about that, but can you spend a minute explaining what that funds can be spent on?
Sure. Is there anything else first?
There's a couple of long examples. People have on.
Okay.
I'll have you just read those because they're pretty long.
Yeah. Does that say, so Marco, can you just email me that question? Let me see, in regards to line 5, I don't know the application by line item. Oh, yeah, Marco, will you just email me that question? I'll get into that detail with you. One other question, I'm sorry, that was emailed to me was the number count that you put, the head count that you put on your loan application, irrelevant. Doesn't matter here, goes into nothing, never really mattered anything. Actually, what it mattered was it was trying to measure if you were under 500 employees. So that's irrelevant, doesn't matter. Why is the formula for initial loan amount different from the loan? Yeah, for self-employed, this is Laketisha. That is absolutely going to be a problem for self-employed. If you're self-employed, you are going to be limited to 8 weeks of payroll, period, even though you were given 13 weeks of payroll. The math does not work out that you can possibly receive 100% forgiveness. It's just the way it all worked out. CARES Act Relief Fund. I will go through some of those questions. I'm confused. Okay.
Are medical waste disposal costs eligible?
You know what? I like that question. I'm going to try to sneak that one in as a utility. That's what we kind of consider it a utility. Again, I said if it's not here, don't ask. But to me, that's a utility. That goes along with waste, trash, and sewage. So I think we're going to kind of try to include that one. I want to answer Millie's question right here. So Millie, you got your loan was dated 4/21, funds deposited on 4/24. 4/24 is when it depends on what period we want to elect. If you're biweekly, so then her first payroll with PPP funds was on 4/28, but that to me sounds like a check date. your period starts on 4/24, and so that 4/28 payroll is covered. And I'll get into some HHS stuff, and everybody will get the slides. That'll all come out. What about the employer portion of health insurance? We pay the premium before a loan was dispersed. This isn't eligible. No, if you paid it before your loan was dispersed, I would say it's not eligible, but the following months will be eligible for your health premiums. Okay, so let's talk a little bit about HHS. Is there any other big ones, Paul, that we missed?
Oh yeah, just moving the money that they got their PPP loan money through a different bank, and they're paying their payroll out of the regular banks, and they transfer the money from the PPP bank to the regular bank. Is that okay?
It is, but boy, I would be I just wouldn't even calculate. I would not elect. Oh, wait a minute. I might have read a question while you were reading one to me.
No, they're just saying that they got you know, their PPP loan is through a different bank, and then their payrolls went out through their regular bank. Just want to know if it's okay to transfer the money from
Yes.
the PPP bank account to the regular bank account.
Yes. And that's what we're recommending on everybody. Transfer the money back and forth, separate bank accounts. And I'm sorry, what I was reading, so I was about to give you a totally different answer, was Millie has a semi-monthly payroll and a biweekly payroll. So they're a company, we've got a couple that, like, they run field staff on one schedule and office staff on another. In that situation, I would just use the regular covered period starting when the date the funds were deposited. I would not try to elect the alternative period for the biweekly payroll. Congress did not, even think that, well, or SBA didn't think that through. I didn't see a huge advantage of the biweekly payroll, the alternate period anyway. So I would just stick with the, whatever that other one's called, covered period. So let's jump on some of these, students for some, for that
gas
one.
cards. There's one on about gas cards paid out to field clinicians. As mileage or as transportation.
You're going to have to justify it to the bank. So I would just ask them and get their feelings on it, get their take on it. So, but it is, we got about 12 minutes and we won't be shut down. I mean, I may go grab a beer at 5 o'clock, but we won't be shut down. If we want to keep going, I'm happy to. CARES Act Relief Fund. I will say that I am doing another webinar. It's going to be 2 hours for TAC, for our Texas Home Care Association. And honestly, I don't know if they're charging for it or not, but mark your calendars, save the date. It's June 16th. So that's 2 weeks from today. It's from noon to 2. So noon to 2, June 16th. I'm going to go through as much as I can on everything. So HHS payments do not have any impact on your PPP loan forgiveness whatsoever. The catch is you cannot spend both monies on the same thing. So you're paying payroll you're using PPP money to fund your payroll. And let's say you do hazard bonuses. Well, then you can't say over in your stimulus, I call it stimulus, provider relief funds, whatever. Under your stimulus funds, you cannot claim those hazard bonuses or the hazard pay as a stimulus expense, not while it's under PPP. Now, let's say you've elected to pay hazard pay, $1 per visit or $1 per hour for everybody that's out in the field working. Under PPP, under your cover period, you keep paying it that way. Those are PPP dollars paying for it. Cool, put it there. PPP's over. You're now into the forgiveness process. You're done spending your PPP money, but you keep paying hazard pay. Now that becomes a stimulus expense. And so as a broad picture of that HHS stimulus provider relief fund, here's what it's there for. You got 2 ways you can use that money. I highly recommend a separate bank account. Again, 2 ways. One is to reimburse you for lost Paul, can you answer her in the chat box about the 2 bank accounts? You can just type it in there. One is to reimburse you for lost revenue, and 2 is to cover additional expenses due to COVID. Those are fairly broad. So in a really quick explanation of them, lost revenue, you want to be thinking about things such as discharges due to COVID, non-admits due to COVID, a reduction in referrals due to COVID, and you want to start quantifying them. You want to create a spreadsheet, and you want to have a tab for each of those, and you want to have discharges. Were they looped? If they were looped, it's super easy to count. You know what that amount is. They were supposed to, I'm sorry, this is home care specific, but if they discharged, you know, if they loop it out, then you know what your HHRG was, you know what you got paid via LUPA. The lost revenue is the difference. If they were discharged and they didn't loop it out, well, A, you got your full episode payment. Then B, were they eligible for maybe a recert? Hospice, if they discharged, how many days did you expect them to be on service? You know what your reimbursement rate is. Calculate it out. What you're going to want is some kind of basis to explain how you calculated this lost revenue. And I mean, I would be detailed. I would be patient by patient by patient, right? On that, on discharges. On non-admits, I would be detailed. I'd be patient by patient by patient. Maybe you don't know what their diagnosis was and you don't know what their HHRG was. Use your average HHRG. Or maybe it was, you know, if you knew, you've got an agency average, or maybe you knew it was type A kind of episode, and you have, like, you know, it was a really high acuity episode. What's your average of those? Like try to ballpark it and put a value to it. Then go to your referrals. Okay, so this has impacted some of our clients. We've got one in Oklahoma City in particular that is very heavy therapy, run by therapists. And so almost everything they do. Can you hear me, Paul?
Yes, I'm sorry.
Okay, well, I just got that little tone in my earbuds that my speaker's going out. I have backup. They do elective surgeries. So if you've got a referral source that does elective surgeries and you're used to getting 10 admits or 10 referrals a month and you've got 0, quantify it. What's your average HHRG times 10 referrals? Now, you're not going to have a name, but you're going to have a doctor's name. And maybe it doesn't even have to be an outpatient, an elective surgery doctor, but just in general, like we usually get 10 referrals a week from this guy and we've gotten 1. Well, then quantify that 9. That's going to be your lost revenue number. Okay, bear with me, guys. I'm going to switch headsets.
Oh, can you hear me?
Yes.
Paul, can you hear me?
Yes, I can.
I guess that's a no.
No, I can hear you.
Shoot.
I can hear you.
Paul, can you hear me?
Yes. Can you
Okay,
hear
good.
me?
Yeah, sorry. It took me a minute to pick the right one. Sorry. So that's going to be your lost revenue. And by the way, my AirPods were fully charged before I got on this, so they don't last very long or something. That's your lost revenue. Expenses, this is kind of going to be the wild, wild west. Think about, because they're not defined. So anything that you can say is because of COVID, it's a necessary business expense, then you're going to be able to you should be able to count it. And I just want to caution you from getting too extreme, right? Just don't go crazy. But if you can legitimately argue that we did this because of COVID, then it's a legit expense. But what the obvious ones are, additional PPP, even stockpiling, stockpile your PPE. Any extra precautions, plexiglass you had to buy to segregate the office. If you had to do extra build out in your office to separate people and move them apart. If you had to lease extra office space to put people further apart, it all counts. If you What else? Sanitizing. I had somebody say they had to spend $4,000 to have their office thoroughly sanitized. Absolutely counts. You wouldn't have done that otherwise. But then you can also go everything to, you know, I even had like some marketing thoughts, right? Because I keep hearing people say marketing is really tough because they won't let you in. All right, so let's say normally you go take a pack of donuts, a box of donuts. What if you went and you bought a 10-foot pop-up tent, go ahead and get you a cover that's logoed, right, the cover, and get you an 8-foot table and get you 8 boxes of donuts. Well, then you go set that up in the parking lot and you get them to come out to you. Like, start getting creative on this stuff, right? And by the way, I'm not very conservative. My approach is I'd go for it. I would document it. I would maybe document it in a little board meeting or a little manager meeting. Hey, we've got this idea. The reason we're doing it is because they will not let us in the facility, and we need we need face-to-face. We need face-to-face time. We need doctor's orders signed. We need whatever it is. And so maybe you don't deduct maybe the donuts don't qualify because you would have done that anyways, but the table and the tent qualify. You see what I'm getting at there? Try to, what expenses. Now, if you're more conservative and have a much lower risk tolerance, then don't go extreme. But any kind of software, if you had to increase your internet to handle all the remote workers, if you had to buy laptops to put in people's homes so they can work remotely when they're usually in the office, if you had to upgrade any of your technology, if you had to invest in telehealth, all of that counts. Now, the other key on these stimulus payments, this money can be spent over time. There's no timeline on it. It just can be spent whenever. And I'm kind of going really long, and I apologize. Are we required to submit lost revenue tax info? Okay. So I'm going to wrap up that kind of, how do you calculate reduction in census? I'll get back to that. So the confusion with the attestation portal, tomorrow's the date, everybody keeps getting the emails. It's very confusing, and basically they assume that everybody wants more money. And if you didn't get more money, you should submit to them information justifying why you need more money. So if you don't want more money, which has been the case I've run into, or you're an agency that when you go and calculate that, you're not even entitled to more money, you've kind of have an overpayment, then they did say they are not requesting, they're not recouping that, they're not taking it back, have it, go with it, it's still, you got to follow the rules. So what we're advising clients is, if you have signed the attestation on the original money you got, you don't have to do anything else. You do not have to provide any more information. If you want more money and it wants an estimate on lost revenues, so it wants you to go in and give them tax returns, and it wants you to estimate your lost revenue in March and April. That's a different calculation. You're going to go as simple as March, April 2019 versus March, April 2020. If you don't have a reduction there, then you can't justify, you can't argue why you need more. If you do and you want more, then go through that portal and go apply for it. Again, if you've already signed the attestation and you feel like you're good, but you keep getting these reminder emails, you can just ignore them. Okay, so that answers Lisa. Should the stimulus money be considered and recorded as income or grant like the Forgiven PPP? Kathy, it is going to be considered income because it's there to be a replacement for income. I would call it other income just to kind of segregate it, but it will be taxable income unless they come out with something saying otherwise, which we do not expect. Now, that being said, if there are any accountants listening, it's not income until it's spent. So in the meantime, it's deferred income, and then you're going to spend it over time. So then can I use my HHS funds for Medicaid expenses? So this is not very clear, but I did have a conversation about this yesterday, and my opinion is yes, because it's still healthcare, and nothing says Medicare only. And we are expecting Medicaid providers to get a payment, a separate additional payment, because you really haven't gotten anything yet. So if you're a Medicaid only provider, A, you're probably off of this call, but B, you should be getting something. But I know TAC sent a letter in to the state saying, come on, let's get this going, but we haven't heard anything more. And so I do think it's fair. Now, what an interesting one that came up is if you're a large Medicaid provider and you've got Medicare, but it's not nearly as large as maybe your provider services, and so you got a payment, or even if this is two entities and you file like a consolidated tax return, in the case where you've got a Medicare entity, a Medicaid entity, one consolidated tax return, my opinion is you probably qualify for a bigger payment, because since it's a consolidated tax return, you could go in and submit your tax return and they would say, oh, your healthcare patient revenues for 2018 were way more than what we calculated, so let's rerun the numbers for you and get you an additional payment. You've got until tomorrow to get that in if you want to get it in. How do you calculate reduction in census? I'm not real sure what that's asking. So if you could email me that question directly, Richard, I would try to get that answered for you. In the panel, in the chat box, we own a PAS and we have all of these expenses, but we don't get that, correct? Dawn, I am expecting that you guys will get some. So hang in there, because I do think you will get some. And then, yes, you can return all unforgiven portions of your loan. So that's good. So I think that's all we got, guys. I really appreciate everybody hanging in there. It's a few minutes after 5. And I don't even know how many people are still on. 160 people still on. I'm very honored to be a source that you trust and that you'll come listen to ramble. So I'm here to help. Again, I'm trying to stay in front of you every 2 weeks. We are now getting into the forgiveness phase. As we learn more and as more comes out, I will just continue to be in front of you. So just watch for things to come out. And we're here to answer questions. We're also here for hire. If you want to hire somebody to help you through this, we're here. So I'll get an email out. It'll probably go out tomorrow with the recording and the slides. So thank you guys very much, and we'll see you next time. And I don't even know how to end it.